We often hear that 90% of retail traders lose money and that 90% of long-term investors make money. In this video, I will quickly explain you why you shouldn't do trading as a retail investor. And at the end of the video, I will show you a Monte Carlo simulation on my computer to show you why statistically retail traders lose money. So first of all, what is trading and what's the difference between trading and investing? Trading is buying and selling financial assets in a short-term period, while investing is buying and holding these assets in a longer period. When I talk about long periods, for me it's about years against month, week, or even daily basis for shorter periods. You can do day trading, you can do swing trading, and you can do different trading on different kinds of assets. For example, you can trade crypto, you can trade stocks, or you can trade currencies. That's called Forex. But why trading is harder than investing? If we take a longer period, the performance of the stock market, I mean the index like S&P 500 or MSCI World, is close to 8 to 10%. In a shorter period, let's take a daily basis, the probability that the market goes up or down is close to 50-50. In short term or long term, the prices are determined by supply and demand. But in long term, prices are driven by the growth potential of the economy and the businesses. In short term, prices are driven by randomness. It's really hard. It's impossible to predict the prices on a daily basis. For example, a lot of people are trying to trade news, but in this regard, markets are efficient. It means that you can't buy good news and sell bad news because news are already priced. That's why we say buy the rumor and sell the news. My last point, and that's only my opinion, but it's that trading is for professional and not for retail. To trade, you need a lot of time and you need capital. You can't start with $100 or even $1,000 because you need to make profit. And if you take your profit, you will have less capital. So you need to start with at least tens of thousands of dollars if you want to live off trading. I mean, to live with the money you earn from trading. And the trader job is very stressful because you constantly deal with uncertainty. As I said before, you don't know if the market will go up or goes down, so it's really stressful. The last point is why retail traders, 90% of them, lose money. There is a lot of studies on that, and I chose to take studies from 2020, a Brazilian studies on Brazilian day traders, and as you can see, they found that 97% of all investors, so when they say investors, it's more daily traders, who persisted for more than 300 days, lost money. If you want more details on this, the link is in the description. Now let's see the Monte Carlo simulation. So, as you can see on my screen, I took two types of performance, the performance of winning trades and the performance of losing trades. I took 30% of performance on winning trade against only less 25% on losing trade. So you can see that even with the better performance on winning trades, day traders lose money. So I took 100 traders and 200 days for the first time. We will take 1000 days for the second graph. Here is the value of the portfolio of all traders. So some lose all their money and some others are $10,000. Now let's see the statistics. There is 23% of winning traders and 77% of losing traders. And if I update the data, you can see that it's always 75-25 or 20-80. The average portfolio is very good, but the median portfolio is close to 10. This means that the majority of traders lose money, but the few people that make money with day trading earn a lot of money. And I didn't say it, but the chances to win or to lose a trade are 50-50. Now let's take 1000 days of trading. So here, don't pay attention to these curves. They are below zero. There is a lot of curves, so it's hard to see, but if you follow the trend, you can see that more people lose money than people make money. Now let's see the statistics. Only 5% of winning traders, sometimes 10%, against 90 or 95% of losing traders. And now we see that the average portfolio is really high, but the median portfolio is always 0. And the data is the same. It doesn't come from an error from the formula. So you see that the more you trade, the more chances you have to lose all your money. It's called a non-ergodic phenomenon, but I'm not an expert in statistics, so I will add you a link in the description about this topic. Thanks for watching. I hope you liked the video and see you next time there for a new video about investment.